Welcome back to Investing Talk Podcast.
Today we're looking at Palantir Technologies.
As usual, before we start, subscribe, like, and comment to this video to support the show. And if there's a specific company you want us to look into, leave it in the comments below.
So let's get into the analysis of Palantir. This quarter delivered some truly phenomenal results, especially their financial performance.
Phenomenal is the right word. It almost looks like a high-growth startup, not an established large-cap software company.
Exactly. Let's start with the top line. They delivered a record revenue of $1.181 billion.
Which is a 63% increase year over year. That kind of acceleration it's huge.
It is. But it's really the quality of that growth that's turning heads.
Quality is the key word, isn't it? Because that kind of revenue spike is impressive, but doing it efficiently is what separates them.
Absolutely. The profitability metrics are, well, they're elite. GAAP net income came in at $476 million.
Which translates to a 40% margin, a strong 40% margin.
Right. And then you look deeper. Gross margin at an incredible 82.45%. And the adjusted operating margin hit 51%.
Okay, let's unpack this for a second. That 51% adjusted operating margin, you combine that with that explosive growth, that puts them into the Rule of 40 club.
Way into it. Their score is 114%.
114. I mean, for context, you have to understand, the Rule of 40 just says your growth rate and profit margin should add up to at least 40.
A score over 100 suggests this kind of hyper-efficiency.
Right.
It's just very rare. Usually you sacrifice margin for growth or vice versa.
Right. They're doing both simultaneously at scale. So what's specifically driving this growth?
What's fascinating here is the sheer momentum is coming from the U.S. commercial segment. That's the end run.
Right, the commercial side, not the government contracts we always hear about.
Exactly. The government side is stable, but the commercial revenue, it just exploded.
The numbers certainly back that up.
Oh, they do. U.S. commercial revenue surged 121% year over year in Q3, reaching $397 million.
And management called it the fastest expansion in the company's history.
It is. And the driver is just the rapid adoption of their artificial intelligence platform, or AIP.
This is where it gets really interesting for me. They're using these AI boot camps to accelerate everything. How does that actually work?
It's about scaling very, very quickly. Instead of a months-long pilot program, they bring customers in for these intense boot camps.
And they walk out with a working solution.
Often, yes. They come in with a real problem like stock optimization or demand forecasting, and Palantir helps them build a working model on AIP within days. It accelerates that pilot to enterprise program pipeline like nothing else.
The commercial scalability it's undeniable, but it's easy to forget the government side is what provides that stability.
That's a critical point. Even with this huge commercial shift, their government revenue still climbed 52% year over year to $486 million.
So that's still a very healthy, growing business. And they're still involved in major initiatives like the OpenDGR project.
Right, that's a big one. It's a major defense initiative to integrate all these different battlefield data streams. It shows they're still deeply embedded in that core strategic space.
And that stability allows them to be so aggressive on the commercial side. The result is just record contract velocity.
The deal flow is incredible. They closed 204 deals over $1 million just in Q3.
And 53 of those were over $10 million.
That's serious enterprise momentum. The total contract value hit a record $2.76 billion.
151% year-over-year increase. That really validates that this isn't just a flash in the pan.
Which raises an important question. How sticky are these customers?
The data suggests they're very sticky. That land and expand strategy seems to be working perfectly.
It does. The average trailing 12-month revenue from their top 20 customers is now $75 million per customer.
Wow. And that's a 30% expansion year over year. So once they're in, they really do expand.
They do. And we're seeing it with new high-profile partnerships, too, like the one with Fedrigoni.
The specialty paper manufacturer, a great example of a traditional industry using this tech.
Right. It's a multi-year partnership to accelerate their digital transformation. They're starting with stock optimization and demand forecasting, all using AI. It shows the platform has real-world industrial applications.
So management sounds extremely confident. They keep raising their full-year guidance.
They do. They're projecting full-year revenue of roughly $4.4 billion now. And they're expecting U.S. commercial revenue to exceed $1.43 billion for the year.
which implies over 104% growth for that segment. That momentum is clearly baked in for the near term.
It is. But now we have to pivot. We have to talk about the flip side.
Yeah.
The valuation. The market is pricing in near-perfect execution.
Near perfect is an understatement. The price you have to pay for this stock is extreme.
Let's put some numbers on it. The PE ratio exceeds 1,500. Even on forward estimates, you're looking at something like 240.
And the price to sales ratio, it's as high as 128.8.
To give that number some context, you really have to compare it to peers.
Right.
Microsoft trades at a price of sales of about 12.46. And even NVIDIA, the engine of the AI revolution, is around 33.3.
So you're saying the market values each dollar of Palantir sales at 4 times a dollar of NVIDIA sales and 10 times Microsoft's. That's a very, very high bar to clear.
It is. It's a massive premium. And you can see that valuation anxiety in the price action, too.
Mm-hmm. Despite those blockbuster earnings, the stock recently pulled back, what was it, almost 22% from its peak?
Yeah, from $207.52.
Yep.
It's what happens when expectations are just running too high. Even a great quarter isn't enough.
And that sensitivity, that anxiety, it makes investors really look closely at things like insider selling.
Yeah, which is another overhang here. Over the last 6 months, there have been 349 sales by insiders.
And 0 purchases.
0 purchases. Now, to be fair, the CFO's $2.86 million sale was noted as automatic to cover tax obligations.
So not necessarily a bearish signal on its own.
Correct. But the overall volume of selling from multiple insiders remains a point of skepticism for some investors.
So beyond the valuation, there are also some structural risks people need to be watching.
2 big ones, really. First is concentration risk.
Their revenue is still heavily concentrated in the U.S.?
Very much so. About 75% of revenue comes from the U.S., and government contracts still account for around 55% of the total. Any shift in defense spending or regulatory policy, that's a real exposure risk.
Okay, and what's the second structural risk? Something on the balance sheet?
Yes, it's about working capital. You'll see their cash and equivalents dropped from $2.1 billion to $1.6 billion.
Which they said was due to investments.
Right, but at the same time, their accounts receivable. That rose 75% to over $1 billion.
$1 billion in accounts receivable, so that's money they're owed but haven't collected yet. A 75% jump is significant.
It is. It can be a drag on cash flow if it takes them longer to convert those sales into actual cash. It's something you have to monitor closely.
And then there's the issue that just never goes away for shareholders.
Yeah.
Stock-based compensation.
The elephant in the room, it totaled $488 million year to date.
Up from $410 million the year before.
It's a constant headwind. While the company is profitable on an adjusted basis, this heavy equity payout continues to dilute earnings per share.
So the value being created is spread across more and more shares. It raises real questions about capital discipline.
It does. So what we have is a company that is, by all accounts, executing flawlessly. You have hyper-growth, top-tier margins, strong cash flow.
But the core tension is whether the current stock price already reflects years of that perfect execution. It's the classic battle, isn't it? An undeniable growth story versus historical valuation metrics. You have to decide if this AI platform is truly unique enough to justify that massive, massive premium over its peers.
It's a high-stakes question for any investor looking at this name. Thank you for joining us for this analysis. Make sure you hit that subscribe button to keep up with all our latest investing analysis.